Hello traders. So today I'm bringing to you a simplified version of order blocks. All right. And in this video, I'm going to be explaining how to identify valid order blocks. And I'm going to explain some of the rules that you need to follow in order to identify valid order blocks. Okay. So if you're interested in this video, please like, subscribe, and share the video. So the first question that everyone has is, what is an order block? Okay, so in a bearish scenario, an order block is the last bullish candle before the start of a strong downward movement. Okay, before the start of a strong downward movement that generates a valid break of structures. So similar with the bullish scenario. All right, so the order block is the last bearish candle before the start of a strong upward movement that generates a valid break of structure. Okay, so in a bearish scenario is the last bullish candle before the start of a strong downward movement, and in a bullish scenario is the last bearish candle before the start of a strong upward movement. Okay, so these are the differences between the bearish and the bullish scenarios. Okay, so let's move on. Traders view these zones as areas where a large number of buy and sell orders have been executed, and therefore we can take advantage of high probability of price reversal and change of direction when price reaches these areas. So our next topic is identifying valid order blocks in terms of candlestick patterns. All right. In a bearish scenario, we know that an order block is the last bullish candle before the start of a strong downward movement. Okay, so when we're looking at this area right here, we notice that this area is the last candle, the last bullish candle before the start of a strong downward movement. So another thing to take note of is the first candle right here. You see the first candle? So one of the criteria is that the order block candle must take out the liquidity or take out the high or the low of the previous candle. Okay, so in this example, we notice that the order block candlestick has taken out the liquidity of the previous candle, or you can just say the order block candle has taken out the high of the previous candle. We see it right here. So the liquidity has been taken out from this candle right here, and therefore we're expecting price to reverse from this area and then continue going to the downside. In a bullish scenario, we see the same thing happening here. And here we notice our candle here as the last bearish candlestick. And when you're looking on the left side here, we can clearly see that this candlestick has taken out the liquidity from the previous candle right here, has taken out the low of the previous candle right here, and therefore we can mark our candle right here as our valid order block. Okay, expecting price to come back from this order block and continue going to the upside. All right, so let's move on. So now we're going to be explaining the essential rules to identify a valid order block. Okay, so rule number one is that price must take out and sweep liquidity. Price must take out and sweep liquidity. When we're looking at this example right here, For us to identify this candlestick as a valid order block, the candlestick must take out and sweep the liquidity either above or below the previous candle, right? So we can clearly see from this example right here that the order block candle has taken out the liquidity from the previous candlestick, and this makes it a valid order block. Okay, so in this case here we notice this red candlestick as an order block, and simply because it is the last bullish candle before the start of a bearish movement. Okay, however, there's a problem here. There's a problem because we notice this candlestick right here. We notice this candlestick right here. So the order block candlestick did not take out the liquidity of the previous candle. As you can see right here, there is a long wick from the previous candle here. There's a long wick which the order block candle did not reach. The order block candle did not reach the high of the previous candlestick, and therefore this makes it an invalid order block. It is an invalid order block because the order block candlestick did not take out the liquidity from the previous candlestick. Okay, and therefore this is an invalid order block. Let's move on. So number 2, the price must create an imbalance and form a fair value gap. And we can clearly see on this example right here that this is our valid order block right here. So when we're looking on the right side here, we notice this red candle right here as the last bullish candle before the start of a bearish movement. Okay, but when we're looking at this example right here, we notice that there is no fair value gap here. All the gaps have been filled. All the gaps have been filled, therefore there is no fair value gap, which makes our order block an invalid order block. You can see the difference right here. On the left side here, there is a gap between the candlesticks. On the right side here, there is no gap between the candlesticks, which makes our order block an invalid order block. All right, and we cannot take any trades based on this order block right here because it is invalid. So the third rule is that order block must be unmitigated. Order block must be unmitigated. We see on the left side we have our order block. We have our fair value gap right here. And we can clearly see that price did not mitigate our order block. Okay, so the order block is still clean. Remember that an order block is a one-time use, right? So if a candlestick mitigates the order block, we can no longer consider it a valid order block. We can no longer consider it a valid strong order block because it has been mitigated. So one of the rules is that order block must be unmitigated because it is a one-time use. So we're expecting price to only come to this order block once, then we place our orders. Now let us look on the right side here. We notice this right here. We still have our order block right here, and also we don't have a fair value gap. So we have an order block right here. We don't have a fair value gap, which makes this order block an invalid. And the third reason is that when you're looking at this wick right here, price has mitigated the order block. You can clearly see this wick has tapped into the order block right there, which mitigated the order block. And one of the rules is that the order block must be unmitigated. And in this example right here, we can clearly see that the order block has been mitigated, all right? And therefore, this is an invalid order block, and we cannot trade this order block right here. Number four is that price must lead to a break of structure or a change of character. Simple as that. Price must lead to a break of structure or a change of character. All right. So in a, say for instance, in an uptrend, this is an uptrend right here, we notice break of structures going to the upside. Okay, we can confidently trade our order blocks because we know that price will continue going to the upside. All right, and then once we see a change of character right here, we know that price is about to change. We know that the trend is about to change. So from here it was an uptrending market, and once we see a change of character right here, we know it's a signal that the upward moving trend is coming to an end. And we can clearly see from here that price started dropping, price started going to the downside. All right, so let us look at this example right here. From here we notice that this candlestick right here is the last bullish candle before the start of a bearish candle, and therefore we can mark it as our order block. Okay, and then again we notice that our order block candle has taken out the high of the previous candlestick right here. It has taken out the high of the previous candlestick. Secondly, we notice that there is a fair value gap here. There's a fair value gap between the candlestick, meaning that price has left an imbalance in the market and therefore created a gap in the market. And so far we can clearly see that the criteria have been met of a valid order block right here. And we notice that once price tapped into our order block, it then started dropping to the downside. All right, so let's take a look at another example right here. With this example here, we notice that this is an uptrend market. This is an uptrending market right here, and we can clearly see that by a break of structures to the upside. We see this by breaking structures to the upside. So now let's focus on this area right here. From here we notice this candlestick right here as the last bearish candle before the start of a bullish candlestick, and therefore we mark it as our order block. Okay, and again we notice that the order block candle has taken out the low of the previous candlestick, which is the first rule of identifying a valid order block. So the candlestick has taken out the low of the previous candlestick right here, and again we notice a fair value gap right here. We notice there's a fair value gap, which makes this order block a valid order block. Okay, but we notice that price did not tap into our order block. It's fine, we continue. Up here we notice this candlestick right here as the last bearish candle before the start of a bullish movement right here. Okay, and then we also identify it as our order block. So up here we notice there's a fair value gap right there, and again we can clearly see that the order block candlestick has taken out the low and the high of the previous candlestick. Okay, and therefore this is a valid order block. And we notice from here that when price tapped into our order block, it then started pushing to the upside. Right. Let us take a look at another example right here. So this is a downtrend, and we can clearly see this by breaking structures to the downside here. Price is breaking structures to the downside, clearly indicating that the bearish are in control. Okay, so from here we can clearly see this candlestick right here as the last bullish candle before the start of a bearish movement. All right, and then we also mark it as our order block. And down here we notice a fair value gap. So we have a fair value gap right here. And again, our order block candlestick has taken out the high of the previous candlestick, and therefore it makes our order block a valid order block. So number one rule is that price must take out the high or low of the previous candlestick, and we see here that price has taken out the high of the previous candlestick, and that there is a fair value gap. We see that price has left an imbalance in the market, which created a fair value gap, okay, which is another criteria that validates our order block. And also we notice that price has been creating break of structures to the downside here. Price has been creating break of structures to the downside, confirming our downward movement, right here. And therefore our order block is a valid order block. And we can clearly see that when price tapped into our order block right then, it started dropping to the downside, All right, guys, so this was a short course of a simplified version of order blocks right here. And please like and subscribe. We still have more videos to come. Thank you for watching.